It is time for us to check in with Amanda Lang, host of Taking Stock, which airs Friday nights here at 6 o'clock and on BNN Bloomberg and the iHeart Radio Network. And Amanda, I guess we'll start today with the most recent story. So those are employment numbers for Canada. We had them announced south of the border today as well. 44,000 plus jobs created. How does this fit into the Bank of Canada's estimation of how well we're doing?
Well might you ask. It's a very strong number, and south of the border, about 250,000 jobs created. And so, in fact, we can kind of extrapolate by 10 because we're about a tenth of the size of that economy. So our job growth at 40 is the equivalent of 400 in the U.S., 400,000. So actually, we're even doing better than they are. But in both cases, it's way too strong for central banks. They are looking for weakness here. They're trying to see signs that their rate hikes have worked and that they're slowing things down. And the labor market just continues to defy them. It is just too strong. So good news for workers, good news for businesses. That means people are feeling good. The bad news is for people who are hoping that the rate hikes are over, because we had our central bank governor just yesterday saying, if the inflation doesn't get to 2%, we will act again. And this suggests that that could be problematic.
So, Amanda, with respect to the numbers, though, I wonder from month to month, you have good numbers and you have not so good numbers. What does it take for the Bank of Canada to actually say, you know what, it's been, 3 months in a row, 6 months in a row, we can make a decision based on these numbers because we believe them now to be consistent?
Yeah, I mean, I think we're probably getting close to that. I would think this jobs report would certainly put the bank on high alert that there may well be another rate hike coming. They're going to look for the actual inflation data, obviously, to really determine if it continues to trend lower. And remember, it has been trending lower, as it should, because we're now getting into the year-over-year period where we're building off of high inflation a year ago. So at some point, even a zero number is still way above, right, the 2 years ago number. So once you start building on the builds, you should see it declining. Is it declining enough? Are they going to be satisfied with it? Those are the real questions. And I have to say, this data kind of suggests that the banks might have to do a little bit more work. So very bad news for borrowers, very bad news for mortgage holders or would-be mortgage holders. Hopefully only one more if we get it. But this, if anything, I would say this tilts us in the direction of more rate hikes, not a continued pause.
Not good. Glad to hear that. I'm just curious what it means that these jobs were part-time, almost entirely part-time, the 41,000 jobs.
There's some seasonality to that, but you're right to highlight it. That's kind of, we consider them less quality, lower quality jobs. We have, though, in recent reports, and I think it was last month, jobs report where they were all full-time. So, it can happen where there's just a kind of a seasonal factor, or maybe people got their hiring out of the way last month and now they're kind of filling in the gaps. Hard to say. These reports, because the month to month does fluctuate, you have to sort of take them with a bit of a grain of salt and look at sort of the longer term trends. But I think that's probably a lot of service industry hiring for the summer.
So I want to go back to the big story earlier in the week, which was the final settlement in that federal public service strike, the Canada Revenue people going back as well, and how much that sort of dribbles down into the private sector. Does it have a domino effect? Because one of the things, and we've talked about this before, is the Bank of Canada looks at wages, at salaries, and all these people got a raise. And I wonder how much of that might have an effect in the private sector.
Yeah, and you could actually flip it on its head and say, how much is the private sector affecting these negotiations? Because we've already seen private sector wages up more than 5%. Private sector is more responsive because there's just more contracts to roll over. The public sector is only getting 3.5% each year for 3+ years. So you could say they're even below private sector gains. The difference, of course, is that these are kind of, in some ways, half retroactive because they were locked into previous contracts at lower levels, and half trying to figure out where inflation is going to go. And we will, again, see the private sector be more responsive, but definitely one plays off the other. When you see 5% private sector gains in wages, the public sector has a strong case to make that they should get, at least in this case, what they got, which is 3.4.
Yeah, and then as you say that, I think to myself, okay, and then of course we're back to here's the Bank of Canada giving yet another set of figures showing, wow, wages keep going up again. So there's another reason to hike interest rates because that's not what they want to see.
100%, and in fact, the bank had sort of said months ago to employers, please try to keep your powder dry. Don't rush to raise wages. The bank really is the Grinch in all of this, if you think about it. But they don't want to see locked-in wage gains, which again will go to these recent government settlements, assuming that they all get ratified. They're okay. They're not 6, 7, 8%, right? That locking in these contracts. They're not terribly high. They might end up being a little higher than inflation in the out years, but not terribly so.
So I was just going to say, speaking of Grinches, I feel like we all have our nose out of joint still with Loblaws, knowing how much they're paying their CEO, and the prices just seem absolutely exorbitant when you go and try and do your shopping. But they're saying, don't blame us, blame the suppliers. Does this argument fly?
It does, in the sense that, and every now and then Loblaws is willing to air its dirty laundry with its suppliers. You'll remember the Frito-Lay incident a month back when they stopped carrying the chips because they couldn't agree on price hikes. Loblaws sometimes feels that prices are imposed upon it by suppliers, and that it has to pass them on or eat the difference. What Loblaws is saying, I think that's interesting and worth noting, is they're surprised that the strong prices are continuing. In other words, they think commodity prices and labor markets have all changed enough that they expect their producers to be not so high priced, and that's an interesting comment. And we don't know whether that's true or not, but what we do know is Loblaws will either have to pass it on or eat it in its profit margin.
All right, let me move on to another Canadian company, perhaps not as well known, Shopify, an e-commerce giant, really, in Canada, making an announcement that they're laying off 20%. It's about 2,000 people. Interestingly enough, the market thought that was great news. That stock rallied this week. It continues to today. So what do we make of this?
Yeah, we've seen a bit of this in the tech world, which is that in the boom times post-pandemic, it's so funny to remember that happened to tech, right? They were on fire. Many of them expanded, and now we're seeing a lot of them kind of right-sizing in a way. They may have gotten into businesses they shouldn't or built out things that were too much capacity. In this case, Shopify expanded into a logistics business that it's kind of getting out of now, and is taking the opportunity, as they sometimes do, to cut some other members of its workforce. 20% of the workforce is a big number. And then kind of to your point, the sad irony is that the stock market sometimes likes this bad news for people because, of course, it means more profit to the bottom line. So good for the stock, but definitely bad for the employees.
But then good in the grander scheme of things if we're looking to lower the employment rate?
I guess that's a silver lining. I like it. Yes. I guess, we could look at these little pockets and say, this is the kind of labor market weakness the central bank wants. I did see a data point that suggests a lot of those laid off in tech are able to find work elsewhere. So it might not be enough for our central bank governor, but I like your optimism.
There you go.
All right, I will ask one last question. In the wake of those three regional banks now, one that had to be taken over by JP Morgan, markets were kind of roiled by this last week, and there's a concern about banks. TD Bank deciding not to follow through in a fairly big deal, right? A multi-billion-dollar deal to merge with a U.S. bank. So, do we have reason to be concerned? Do you think?
Still no reason in terms of the safety of our banking system, and in fact, the TD decision not to follow through on the First Horizon acquisition could well be interpreted as an abundance of caution on TD's part. They don't want to expose themselves to this particular part of the U.S. market. That part of the U.S. market, which is regional banks, may well still be vulnerable. There could be other shoes to drop, although we're probably past the worst of it. There's lots of work being done in the U.S. to make sure that depositors feel safe and that the banks have access to some facilities to make sure they don't have to, hit the wall the way that we've seen so far. But there could be one or two others because it's a risky part of that market for sure. We are safe in Canada is the main thing.
That's the part we need to be sure of. All right, Amanda, thank you so much. Appreciate the time.
Always great to talk.